Welcome to the May market outlook from the blockchain.com team. We're very grateful for everyone's time today. We have a lot to cover and then a very special guest to pick their brain on a variety of topics today, especially all things legal. I'm very excited to be introducing Aaron Wright, who will be our special guest today. So without further ado, my name is Nicholas Carey. I'm the co-founder of blockchain.com, as well as the founding commissioner for the Blockchain Commission for Sustainable Development. I also co-authored The Future is Decentralized, and I'm very excited to share with you a little bit about some of the amazing things the team has been working on. First off, blockchain.com is probably most well known for its wallet. We are here to build software that makes it easier for all people all over the world to be able to do things like send, receive, secure, trade, and exchange digital forms of money. And so our wallet is really the first place people go to start to explore the blockchain.com digital currency experience. We've also built a professional trading venue, the blockchain.com exchange. You can get signed up in under 30 seconds. And that's more of a professional trading venue for people that want to trade large volumes. The blockchain.com Explorer is still used by academics, policymakers, and more that are looking for evidence of what's happening on the public ledgers. And we continue to support a variety of charting capabilities there that are used by media and the press very regularly. We have a borrowing feature. We have a simple capability for buying your first crypto. And we also have a deposit feature where you can store your crypto at blockchain.com and earn some interest on that. And for all the engineers and programmers out there, the APIs are available to build on top of our experience as well. So the team at blockchain.com has been extremely busy the past 30 days. We have launched instant USD transfers for the exchange and the wallet. Due to popular demand, we have launched Dogecoin support on the blockchain.com exchange. Doge has been trending on Twitter for the past week. Elon Musk has become known as the Doge King. And we've seen a significant amount of trading volume on that meme coin, which is pretty interesting. Faster crypto simple swap experience. This is the capability inside the blockchain.com wallet that lets you trade between things like Bitcoin and Ethereum and Stellar and more, has been improved. We've launched the Wrap Digital Gold token on the exchange and wallet as well, which is a pretty interesting product. Bitcoin Cash and Stellar are live as assets for the interest accounts. And then that's also available on Android. And we've made a bunch of optimizations across the whole platform. So as usual, make sure your apps are current. Please make sure you're staying updated with your Android and iOS wallets. You've got some great new features available on those platforms based on feedback we've been getting from our community. A screenshot, I think, next of the exchange where we've just launched a bunch of new assets as well. The interest rates for May have been published on our blog. So if you are holding on to crypto and you want to have a longer term position there, but also earn some interest on your funds, this is a really exciting way for kind of passive interest accruing to occur. And these rates are all significantly better than what you would get holding dollars in your bank account today. So one of the core arguments at the moment, especially in an era where inflation is potentially going to be a real topic in the markets, these interest levels are quite significant. So anyway, I think that's probably the summary of all of our work. The blockchain.com exchange, that professional trading venue again, is available for anyone who wants to dabble in that. We've launched some new pairs this month, including support for DOTs, which is a very exciting project by the Polkadot Foundation. Doing some really innovative work in Web3, and we hope to have a guest from that community in the not too distant future to talk a little bit about their roadmap for 2021. So last time we spoke, we covered what was going on in the markets. Obviously March and April have been incredible from both the volatility, but also just general adoption and news stories coming out. We covered some on-chain insights for Bitcoin, and then we had our special guests, Caleb and Weektek from the Engine team that are building an entire ecology of services for the gaming community, digital games, and an economy, basically, and a currency for that. So it was really cool to hear their perspectives and the merging of both the gaming and the financial technology communities. So without further ado, today's focus, again, we'll provide a market outlook led by our colleague Garrick Hallman, some on-chain insights from our Block Explorer team, and then our special guest, Aaron Wright, will be joining us at the end, and we'll work through the content at the beginning to get to him as we're very excited to spend some time with Aaron today. So I'll be handing it off to Dr. Garrick Hallman now, who's our head of research here at blockchain.com and one of the world's most cited cryptocurrency and blockchain technology researchers. He wrote one of the first courses at Cambridge University. He's regularly asked to participate and share his perspectives in the media and press, and he has been very, very busy the past few months. And so very excited to have Garrett now take the reins and lead us through this month's market update.
Great. Thanks so much, Nick. So we're going to move through this material pretty quickly so we can get to our conversation with Aaron to talk about DAOs and the legal landscape. But April, real quick, Ethereum, new all-time high, continues to set new all-time highs as we start May. Bitcoin lagged a bit, down 2% for the month. And so, we've continued to see, Bitcoin's dominance shrink a bit as Ethereum and the broader universe of crypto assets are appreciating more rapidly in value. Across the board, in terms of the rest of the markets, stocks continue to perform well, up 5%, great month in April. The long bonds, treasury bonds found some supports. That was interesting. They've been kind of drifting lower, and gold actually found a little support as well. Gold's been drifting down for most of the start of the year, with the US dollar also kind of turning negative after rallying a bit to start of the year. So Bitcoin and the dollar were kind of down, everything else basically up for the month. Now, when we look at the Ethereum price, I think one thing to keep in mind, people ask how high can it go? If you zoom out and look at it in BTC terms, while Ethereum's setting a new all-time high price in USD terms over $3,000, it's nowhere close to its all-time high relative to Bitcoin, which it achieved back in July 2017, which is the red line you can see there. Today it's still less than 0.06 ETH per BTC when it got up to 0.14 back nearly 4 years ago. So, there's potentially significant more room here on a BTC basis for it to go up and achieve its all-time high. So something to keep in mind there. We mentioned how Bitcoin dominance has been drifting down since the start of the year. It was as high as 70%. It's down now, getting into the low 40s, mid 40s, I guess, percent. And it's an interesting question to ask, like, what is the appropriate level of Bitcoin dominance? And this is, again, for those new to this metric, it's the market value share that Bitcoin represents in the total universe of crypto assets. So going from almost 70% down to the mid 40s is a pretty significant change. And that reflects, I think, things like, the boom, the NFT boom, the continued rise of DeFi and Ethereum's importance, as well as a lot more interest spreading to Polkadot and other platforms that are building and developing. We're seeing stablecoins kind of branch out a bit. There's been reportedly more Tether volume activity on Tron, for example, than there is on Ethereum these days. So this kind of broadening and deepening across the crypto asset ecosystem is something we're watching, and I think is actually pretty healthy in terms of building a broader and richer and deeper ecosystem, and reflects, I think, real traction in some of these other applications that are being developed, like decentralized autonomous organizations, which we'll talk with Aaron about here in a second. This is the non-Bitcoin and Ethereum market share, and you can see it's gone up from 25% in January 2020 up to over 35%. When you do think about, like, every top 100 project on CoinMarketCap having $1 billion plus valuation, there's questions around how sustainable that is. Some of these, as we've talked about, altcoins, if you want to call them that, I don't know if that's a fair term for some of these projects, but some of them have only been around for a very short time, don't really have much long-term track record, and have achieved remarkable valuations very quickly. Just keep that in mind as you're thinking about moving, out on the leaderboard of what you're thinking about investing in. And if there were, a correction, our expectation is that value will concentrate in the strongest projects that have the most traction, most users, et cetera. So be careful out there. But when we think about the whole macro context, and we titled this month's webinar Trillions, because we've comfortably moved into the 2+ trillion total market value for all crypto assets. And we think about what over the medium term could sustain that or even drive that market valuation level higher. I think there's two huge things that are kind of still propelling this. One is, the ongoing institutionalization, which we've talked about, of the crypto asset space. And if you just look at, this was a nice little media snippet capture that was put together showing how many different Wall Street firms have done basically a 180-degree turn and about face and reverse their view that this was a fad or it's not an asset class. JP Morgan, Morgan Stanley, Goldman Sachs, and they're now setting up products for their clients. And it's in the very early days. These products that Goldman, Morgan, Visa, et cetera, JP Morgan are rolling out are just kind of getting going. And so this institutionalization is still in the very early days. We still don't have things like a Bitcoin ETF. CME Group just launched their Ethereum futures market, which is still kind of getting some traction. So there's a lot of, I think, upside that could be driven by the ongoing institutionalization of crypto. And then we talk about how legacy assets like gold still are 10x more valuable than something like Bitcoin, for example. And arguably Bitcoin's a lot more functional, has much more kind of capabilities than gold. So I think over the medium term, the valuation outlook looks fine, but that doesn't mean in the short run we couldn't see some massive correction, and people need to be on the lookout for that, especially if you're playing with leverage. So let's quickly get to the on-chain insights now before we go to Aaron. In the month of April for Bitcoin, we saw a pretty big decrease in activity on chain, and at the same time there was a sudden drop in hash rate, which helped propel Bitcoin transaction fees to, I believe, their highest average level in history, $30 a transaction for the month of April, which is quite significant. So the hash rate drop that was purportedly in response to a kind of energy outage in China was captured by our hash rate chart. We have various ways of looking at the hash rate, which is the total computing power of the Bitcoin network. And there's some controversy around how we measure this. I think it's worth kind of reminding people that this is an estimate. Hash rate can never be known precisely. We can only estimate it. And we estimate it over various timeframes, including 24-hour periods, where there can be some inaccuracy around the precision of this estimate. But we think there's still value in having a 24-hour kind of look at hash rate that can help provide an early warning, if you will, system for something like what we saw last month with a lot of computing power going offline suddenly. That could be a very significant kind of event that our charts are helping to alert people to. But if you do want to have a more I think kind of precise kind of view of what's really going on, you might need to zoom out a bit and look at the 7-day average when looking at this chart. And you need to be careful in how you're interpreting the hash rate, because it is an estimate. We talked about the fees, the average being $30. We actually saw fees as high as $60 a transaction for Bitcoin last month. And we were trying to think of what to compare this to, people willing to pay as much as $60 for a Bitcoin transaction fee. And we thought, a really, really nice bottle of wine is something people would pay $60 for. I think some people are still paying around that amount for a video game. I think Call of Duty is retailing for $70-something on Amazon. But there is a silver lining to these high fees. They do, of course, negatively impact what you can build, as we'll be talking to Aaron about, on top of these blockchain platforms. When fees are that high, you certainly price out smaller transactions and maybe smaller retail users of these networks. But arguably high fees and the fact that people are willing to pay them also help make the case that this is a really valuable economic network that's being built, and there will be fee income to support the security of the network, which is fundamentally what that fee is really there for. It's to incentivize, in Bitcoin's case and Ethereum's right now, why it's still on a proof of work system, the computing power to be of sufficient size to really secure the network. So there is a benefit, a silver lining, if you will, of these high fees. And it may, help silence some of the doubters about, well, these fees go so high, no one's going to use these networks. and the security is going to be a problem, this is certainly evidence to the contrary. So without any further ado, we're going to now turn to our virtual fireside chat with my friend Aaron Wright, who I met way back, I believe, in 2015 at Consensus in New York, the very first Consensus conference. Is that correct, Aaron? Am I remembering that correctly?
Yeah, that feels about right. It's all, in crypto land, it's all a bit of a blur. So it feels like maybe that was like 30 years ago, but yeah, it's been a long time. Thank you so much, Garrick and Nicholas, for having me on. Really excited to dive in and chat a little bit more about DAOs.
Awesome. Well, before we get started, we have a little tradition around here, Aaron, and all folks who join the Blockchain.com podcast have to answer a question so we can get a little sense for how you earned your first buck. And we want to know your story of how you earned your first dollar, peso, or buck or whatever when you were a young guy.
Yeah, it was definitely $1. I vividly remember this. I was an enterprising young kid, and the first money that I ever earned was by reselling baseball cards. I would put together custom packs and sell them in school. And I walked home one day with a remote control car, which were at that point in time pretty expensive. And my mom was worried that I was selling drugs. I was like 8 years old. So A, hysterical that she thought an 8-year-old would be selling drugs, and B, a pretty good story.
I love the dark market on the school playground there with baseball cards. That's cool.
Now you know why I was gravitated to crypto so early. So
that makes sense. So help us understand quickly sort of your own personal summary of journey and how you brought your passion for the law and crypto together. And yeah, I'd love to hear that.
Yeah, sure. So I have a background in law and technology. I'm a professor at Cardozo Law School in New York, where I focus on emerging technology and in particular blockchain technology. Before joining Cardozo's faculty, I did a lot in the Wikipedia ecosystem. I helped build out the for-profit version of Wikipedia called Wikia and helped grow that into one of the largest internet properties around. I became enamored with open source tech. It's one of the reasons why I was deeply interested in Wikipedia. I got to work very closely with Jimmy Wales, the main driver of Wikipedia, and helped build one of the first open source search engines, a little bit before DuckDuckGo, but directionally kind of in the same direction. And I have a background in law and also economics and history. So I became incredibly enamored, not surprisingly, with Bitcoin very early on. It hits me like literally in every single sweet spot. So starting in 2011, I just began to fall down the Bitcoin rabbit hole. I became really fascinated with the entire ecosystem, including a lot of the ideas which really rooted in Bitcoin, things like smart contracts and DAOs and DACs and all these concepts that are now breaking into the mainstream. And also had the opportunity to play a small role helping to launch Ethereum and supporting lots of different projects in the Ethereum ecosystem. But I, am a lawyer, first lawyer in my family, and an academic. And I've also spent quite a bit of time just thinking about some of the law and policy related issues as they relate to Bitcoin and also just more generally blockchain technology. So that's kind of how I got here.
Awesome. Well, I think Garrick has a bunch of questions to pry into some of those topics. So I'll hand it off to Garrick here.
Great. Yeah, thanks, Nick, and yeah, Aaron. So much ground to cover, and I guess we wanted to talk, of course, about DAOs, but maybe just before we get to that, there's a lot of focus from regulators again today on the crypto asset landscape. This seems to kind of ebb and flow with valuations, and what's just kind of your general kind of like helicopter view of kind of the legal landscape for crypto assets, like how far along the journey of maturity and regulatory understanding are we, maybe compared to say 2017, or historically, where are we? You can use baseball terms since you mentioned baseball cards. What inning are we in? Whatever you want to use to describe kind of the state of legal crypto.
Yeah, well, I don't think we're in the first inning anymore. It feels like we're probably more in the third or fourth inning. Particularly as it comes to Bitcoin and other more established, quote, blue chip digital assets. I think the strongest signs of that fact are the fact that major institutions are now feeling comfortable custodying Bitcoin as part of their treasuries. And my understanding is it's not just limited to Bitcoin, that there's other assets that are also increasingly being held by large corporate entities or other large funds or other large institutions. So I think that in large part is a testament to the great work of a number of different lawyers, kind of these unsung heroes that are sorting through the complicated issues that are necessary in order to enable these institutions to hold these digital assets, trade these digital assets if they need to, and also make sure that the risks are appropriately calibrated. The biggest legal issues in 2016 to 18 really dealt with tokens and the characterization of different tokens, if they were being bought and sold and used to fund new technology projects. We've seen that work through several courts here in the US. We've had regulatory clarity from other jurisdictions around the globe as to what they are or are not going to be considered. The answer is there's a window for lots of these assets to not be considered securities. Plenty of them are still going to be considered securities. But I do think that that's been helpful in ensuring that well-intentioned entrepreneurs can make rational and reasonable decisions as they want to build out their projects. But there's still lots of challenges that are emerging, and in particular as it relates to decentralized finance or kind of this broader vision of entirely digitizing Wall Street. So knotty questions there. Still some lingering questions related to the characterization of certain new types of tokens, which people refer to as governance tokens, and whether or not those will be characterized as securities or commodities. And obviously lots of more nitty-gritty questions that are deeper legal questions, which I imagine will bore everybody on the chat and call or tuning in if we dove too much into it. But I think there's been a lot of progress. I do think, like you both teed up before, now that trillions of dollars in assets are being represented digitally, now that we have large publicly traded companies that are involved in dealing in digital assets, I do think that we're rapidly approaching a more mature landscape, which hopefully will continue to grow. I guess the last thing that's still a lingering problem and always kind of a lurking issue are these AML, know your customer concerns. It's still not clear what that's going to look like, both in the US and internationally. But I imagine over the next couple months, under year and a half, we'll have a pretty clear picture, at least with regard to major jurisdictions, as to what they're thinking about there and what some reasonable rules, hopefully reasonable rules, will look like.
Yeah. No, I'd love to just, before we jump into DAOs, actually just chat about that, because I think this is a huge question, and striking the right balance is going to be tricky. It seems around the DeFi space where I guess what is your perspective on this? There's been obviously these rules have been talked about from the U.S. Treasury around kind of non-custodial wallets and potentially impacting the ability to move funds around in DeFi protocols. Is there some kind of threshold that's going to work that is going to be the compromise, do you think, to if a transaction is below a certain level, that it's not going to need to be necessarily fall into this kind of this regulatory regime, or are we actually going to see down the road kind of protocols? Been having this conversation with some people on the tax side, kind of bake into the protocol compliance, and automate in some ways tax compliance. Could there be something similar? And is that where this kind of ultimately winds up from the AML KYC perspective?
Yeah, I think those are tricky questions. The AML, know your customer issues, are always kind of the third rail of crypto. That's where regulators seem to draw the firmest line. It's not 100% clear where that lands, outside of the fact that centralized exchanges or custodial services, and/or crypto to fiat gateways likely will have a heavy amount of regulation. There seems to be a push to try to impose that on more decentralized protocols. But my instinct is, even if that's implemented, one, it's unclear how those protocols will actually implement it. And those well-intentioned protocols that do implement it will likely just have that functionality forked away. We've already seen that with decentralized exchanges, like the drama that happened several months back between Uniswap and SushiSwap. So it's a bit of a pickle for regulators on where to put their thumb. They can press, but if they press too hard, I think that they'll wind up with something that's even more unregulatable. And that's obviously not an empowering position to be in. So I do think that there's still a lot of learning that needs to be done. And, frankly, I do think regulators are going to have to begin to shift a little bit on their perspective of where regulations should lie. The last area I think, which is ripe for applying AML and know your customer related regulations, is probably the aggregation layer that we're seeing emerge on top of DeFi. So, there's lots of protocols that are kind of the pipes of this emerging ecosystem, but there's online sites and portals and kind of on-ramps that are not crypto to fiat gateways that presumably could shoulder a bit more compliance. So it's a bit unclear. Frankly, the DeFi-related regulatory questions are probably the trickiest ones that I've seen, and I do not envy the position of many global regulators as they have to sift through it. But I imagine, look, people are making money, and if people are well-intentioned, regulations will emerge, and hopefully we won't throw the baby out with the bathwater as part of that process.
Yeah, well, I know you've received a lot of invitations to come in and brief regulators. I'll see you from time to time at the OECD, as we talked about, and one of the, starting when I started getting these invitations back in 2017, 2018 to come and explain DeFi and very early days, what is a decentralized exchange? It would just blow the mind of a regulator. Wait, there's no address, no person I can call up. This just lives permanently, immutably on a blockchain. But DAOs, decentralized autonomous organizations, were another thing that would often blow the minds of regulators. We wanted to spend some time on this call today, kind of introducing people to DAOs who are new to the topic, talking about where we are, in terms of their development, their issues, what problems they solve, what's exciting about them, and of course the breaking news out of Wyoming. But let's start with kind of an introduction to DAOs. How do you, when you're explaining a DAO to someone for the first time, do that?
Yeah, a DAO is a very broad category. It stands for Decentralized Autonomous Organization. There's always a debate as to the degree of autonomy that these organizations can have, but they tend to kind of get broken down into two buckets. One is a decentralized organization, or a group of folks that are working together, oftentimes making decisions in a participatory manner, i.e. by voting or some other kind of inclusive process. And then the second category is a DAO that is more autonomous, that's being run entirely or primarily by software-based code. So some folks have argued that Bitcoin itself as a network is a DAO, right? It has a protocol that coordinates all this activity of humans at the edges. Humans voluntarily decide whether or not they want to interact with that algorithm and that protocol. But it's not fully autonomous, right? There's some core developers and some other folks that are chipping in and kind of weighing in on its development. On the flip side, the other way to think of these decentralized organizations, or DAOs, as some people call them, it's really like a subreddit with a bank account and a lot more rules. So if you think about, the internet, we've seen large groups of people band together and, make their voices heard. They've impacted the way politics operate. They've, increasingly shaped public perception and culture. But in many ways, they're toothless. All they can do is yell as loud as they possibly can to have something change, or push some sort of idea or meme into the consciousness, but they don't have any capital. And so I think the broadest vision of what people want to do with DAOs is explore, how to arm these groups of people, these swarms on the internet, with capital and with sufficient rules so that they can do things proactively and productively. And that's why I think so many people have been animated by DAOs. The notion of DAOs really started with Bitcoin, like most things. So Dan Larimer, who was an early Bitcoin enthusiast and now has done quite a bit with the EOS ecosystem along with several other projects, kind of pioneered the notion of transforming corporations into digitally native organizations. He referred to them as a DAC. And that was way back in, I think, 2013. So these kind of concepts have been floating around for a while in the Bitcoin ecosystem. Vitalik Buterin and a lot of the folks that helped build Ethereum really took those concepts and generalized it into this DAO idea. And DAOs have been kind of deeply embedded into this broader blockchain, Bitcoin, Ethereum conversation now for almost a decade, which is incredible to think about. And there has been a lot of progress. The first DAO itself was a project which was aggressively named the DAO. In many ways, it was trying to build a decentralized venture capital fund. So think about a group of people coming together, this kind of collective hive mind, identifying the best projects in the space, and then providing capital to it. It was a spectacular disaster. It raised a tremendous amount of money due to a technical issue. It blew up. It created a whole bunch of drama in the Ethereum ecosystem that Bitcoin folks love to needle Ethereum folks about, and Ethereum folks like to defend in different ways. And after that, there was a lot of PTSD, right? People were afraid to kind of deal with it. It was a big mess. But starting about a year and a half ago, the folks in the Ethereum ecosystem shook off their PTSD and began to kind of rebuild. The first substantive example of that was a project called Moloch DAO, which was a grant giving DAO. It pooled together money. People collectively decided who should receive funding for some technical projects that they were working on. And since that point in time, it's really grown leaps and bounds. Just to give you a sense of numbers, because I looked it up right before our chat, I assume some folks here would like numbers, that if you go back to February of last year, so February 2020, there was $10 million in digital assets being managed by DAOs, and there was several thousand people or several thousand addresses. So, at the most expansive view of an address participating in it. Today, it's nearly $1 billion that are being managed by these structures, and there's tens of thousands of people that are participating in them. So it's an emerging part of the blockchain ecosystem, in particular the Ethereum ecosystem, where we're seeing a lot of growth. And it reminds me, being kind of an old dog in this space, of what we saw with DeFi and some of the other curves that we've seen kind of emerge out of different ecosystems. So it's a pretty exciting time and a pretty interesting concept conceptually.
Awesome. That was very comprehensive and authoritative. So two follow-ups right there. One is, you mentioned the DAO, which is, I think, for those who at least were students of kind of crypto history or around back then, is kind of their first encounter with something called a DAO. And that's where I think a lot of the kind of awareness of what a DAO was kind of originated from. There was some SEC work around that. How can you talk about their interpretation of the DAO and how that has affected and shaped kind of the evolution of DAOs since that ruling, if it was referred to as that, came out?
Yeah, so the SEC took a look at the DAO structure, and this was their first foray into analyzing tokens. So they looked at the DAO structure, which had a native token, the DAO token, and they issued a 21A report. So just for some context, that's a report that's not binding. So nobody was found to violate the law. It was almost like a policy paper type analysis. And they found that the tokens in the DAO itself were considered securities. Why? Because you were pooling assets to make a profit. And they found, although I think that they were a bit off on this, that you were relying on the efforts of other parties because there were some major holders of those tokens in the DAO to make decisions. And so they classified those interests as securities. And that's one of the big challenges with DAOs. If you're going to have a native token in one of these DAOs, what the heck is it? Is it a security? Is it a commodity? It's kind of a reminiscent of the same types of questions we had around tokens in 2016 to 2018. The second issue with the DAO was it blew up. It was a spectacular disaster. An attacker, hacker, thief came in and drained the DAO of all its assets. So it was unclear, who was going to be responsible in that instance. Were all the members individually responsible to one another? Was the hacker responsible? Presumed hacker responsible? Lots of open questions related to that. And fortunately, because the Ethereum network forked, they basically wiped away all the issues with the DAO, which was very contentious. Nobody had to grapple with that, but those types of questions kind of still linger. But these types of experiences, both with the DAO and with the SEC's 21A report, has shaped the way DAO technology has been developed. As an example, the Moloch DAO framework has no native token. There's no native token that's involved. And my sense is the developers that put that together were probably a bit concerned about that native token and whether or not their creation of the token would create some sort of regulatory risk. At the same time, we've seen, to deal with all these ancillary issues we saw with the DAO itself, a movement to begin to wrap or peg DAOs inside of existing legal structures so that they could deal with some of these real world risks that people began to see glimmers of with the DAO itself. So it's definitely shaping kind of the ecosystem There's a couple other subtle issues that are floating in the background, like what should govern? Should it be a paper-based document? Should it be code? How are we going to kind of order priorities of things? And that's the types of geeky legal issues that people are sorting through.
Cool. Yeah. So I want to now turn to a classification question, because there's this kind of tug of war that sometimes occurs in crypto around, for example, what is DeFi? Some people will limit that to what's built on top of Ethereum, and that's what DeFi is, a pretty narrow maybe definition in some people's minds. Some people will say, well, maybe Bitcoin kind of meets the definition of DeFi. You mentioned Bitcoin is kind of a DAO in a broad sense. I'm thinking of some of these money market protocols that have governance tokens, Compound, Aave, and others, some of which are available to trade on the blockchain.com exchange. I mean, where do we draw the line around what is a DAO? For investors, for example, they're trying to think of how we define a class of assets that might fit under this kind of heading of DeFi or DAOs. Where's the line really in your mind? Is there a line that we can really neatly draw, or is that impossible?
In the crypto ecosystem, we don't like neatly drawn lines, unfortunately, and this is no exception, right? So DAOs, I think, are coalescing into several buckets. I think that may be the best way to think about it. The first one I'd call protocol level DAOs. So these are the DAOs, like you mentioned before, Garrick, related to Compound or Aave, or some of these larger DeFi projects. The concept is that there's a governance token. So the holders are not beneficial owners in any way of the underlying protocol, but they can weigh in on certain parameters or certain changes to the way that the protocol operates. On balance, I think that's a good thing, right? It's almost like stakeholder governance, something that's kind of animated lots of different academics and policymakers over the past X number of years. But having users or people that are kind of interested in a particular project weighing in to make sure that it's being administered in some sort of socially beneficial way. The second kind of major category of DAOs that's emerging are really investment vehicles. So kind of a modern evolution of a fund or a fund-like structure. And that there's a number of examples there, projects, some of which I'm affiliated with, like the DAO, Flamingo DAO, Metacartel Ventures, Pleaser DAO. There's a whole ecosystem of that. The concept there is pool together assets, rely on this kind of hive mind to sift through the information on the internet, find opportunities, and then work collectively to take advantage of them. The last category, which is a bit more nascent, is related to service providing DAOs. So people coming together, instead of pooling capital, they're pooling their human capital and are basically using it as a more open-ended group of folks to perform contract work or other work like that. So those, I think, are kind of the three buckets for it. Going more broadly, organizations today, span lots of different use cases and categories. I wouldn't be surprised if we see a similar proliferation over the next, 3 to 10 years as kind of this subsector of the blockchain ecosystem continues to grow.
Cool. Now, I think this is a nice point to kind of talk about kind of the new functionality, the new things you can do with DAOs that weren't really possible before. I remember regulators, when they were concerned about ICOs and expressing concerns about what real value they added, I would make this comparison to traditional crowdfunding platforms where you may send in some money to fund a project. And as soon as you sent the money, you would have no visibility into what was happening with that money. And there were lots of problems globally, in Asia in particular, where people would run off with the money, wouldn't really meet their obligations or meet their promises. And so that transparency that ICOs offered, where you could go on chain, look at the address where funds were sent, and at least see what's happening with your funds and other funds that may have been sent to a project, offered a new potential benefit to fundraising via a blockchain ICO type process. But what added functionality, what new things can you do with DAOs that weren't really possible before?
Yeah, and I think that transparency is one, subtle but very important advantage, right? You can track every single thing that's happening inside of these organizations, every transfer of funds, every investment, if that's applicable, every vote. It's all much more transparent, and much more transparent by default than what we have in kind of legacy institutions. And there's huge advantages to that. That means that people can take that data and begin to surface it in new ways. So we're seeing, analytics platforms that are automatically aggregating information, collecting information, tracking proposals. For protocol level DAOs, we're seeing aggregation services like Boardroom and Tally and a handful of others that are enabling you to see every single issue that's up for vote in various different communities that you're a part of. And not only that, you are beginning to see the threads of something that's like a proxy-like voting system. So seamlessly being able to delegate to another person the ability to vote on your behalf. So today, that's really hard to do. If you're a shareholder in a corporation, you get a paper mailing, it's sent out, you got to fill out a form, send it back. It costs millions of dollars to kind of delegate your voting authority to somebody that may be in a better position to weigh in. Here, it's as seamless as other online services, right? And that's pretty fascinating. On the kind of organizational level itself, we're seeing in the smart contracts very, very strong, what lawyers or corporate law scholars would say, minority rights. So the ability to basically retain control of your assets, even though it's been deployed into a collective vehicle. So in the Moloch DAO framework, as an example, there's a colorfully named function called rage quitting, because we have to pick like a really fun name for it. But what it means is if you pool your capital at any point in time, if you're so angry, you're so upset that you want to quit, you can pull any undeployed capital that you're entitled to right out. You don't have to ask anybody for permission. You have to call up the fund manager, go through the legal documents, have that fund manager say, no, I'm not giving your money back. Go hire a lawyer. The lawyer has to go write a nasty letter for you to get your capital back. You literally have to click a button. And that I think is really important. That means that you can really take control of your assets, just like we've seen, one of the major drivers of Bitcoin, being able to control your wallet on your terms is critically important. But that same notion, that same concept is being kind of ported into DAOs as well. The other advantages are just security. Now, there's obviously questions about the underlying smart contracts, and I'm sure we're going to have lots of wrinkles, warts, and hiccups related to that. But it is nice to know that you can use a DAO to begin to expand some security features, assuming that those smart contracts are secure. So instead of trusting just like one other person or two other people in a multi-sig, you could trust hundreds of people to kind of keep those assets secure. And there's some advantages to that, I think, as well. And then the last thing I just say is speed. It's really amazing how fast you can pull capital with digital assets. We saw that with ICOs and token sales. It was incredible, right? And that same feature you can get a glimmer of again in a little bit more contained way in some of these DAO structures. I'll give a couple examples. There was a DAO that launched a couple weeks back called Neptune DAO, raised $30 million into a fund in an hour. I mean, that's pretty astounding. If you're trying to do that today as a traditional fund manager, that's probably like a 3 to 6 month endeavor, even if you have a pretty prominent track record. At the same time, we've seen in the NFT ecosystem, people pool together capital to buy an NFT. There was a great example here in a project called Pleaser DAO, where they pulled together, I think, over $5.5 million to buy Edward Snowden's first NFT. But that happened spontaneously, kind of emerging on the internet. So some of this kind of hive mind, swarm-like activity that I think we all instinctively know exists online, there's now kind of productive ways to channel that. And then at the same time, the technical infrastructure provides a bit of security, high degree of transparency, and also still aims to give participants the ability to control their assets, which I think is pretty interesting as well.
Awesome. I want to turn now to kind of the big, hairy, audacious vision for DAOs. There was this nice podcast that Chris Dixon did from Andreessen Horowitz, venture partner there with the Invest Like the Best podcast. Recommend that. We include things like that, by the way, in our monthly blog, what we're reading and listening to. So you can look for a link to that at the bottom of our monthly Outlook blog post. But he he talked first of all about like which white papers he would always recommend that people read. He said, the top 3, he'd say start with the Bitcoin white paper, read the Ethereum white paper, and then number 3, read the MakerDAO white paper. And it led into this conversation around how, as incredible an invention as the limited liability company was, in the 19th century, and how it helped, manage risk and so on and so forth, and help build the railroads. that today it leads to situations where you have these information networks where there's an incredible concentration of power and wealth in the hands of the owner, whose interests may oftentimes be at odds with the users on the platform, and how tokens offer this kind of really exciting opportunity, for kind of incentive alignment with people who are helping to build and use a platform. I just wanted to kind of get your perspective on how big DAOs can get, and is this kind of one of the key or the key kind of ingredients to kind of solving this issue today, where we have this massive, it seems, misalignment of incentives and problems around privacy and so on with people who are using a platform, a social network or whatnot, and the owners of that platform. And where can this go? I mean, is this going to replace limited liability companies? Is this, are we all going to be working for DAOs, down the road?
Yeah, I mean, I think the answer could be yes. So I think that's a really great comparison about corporations and other corporate innovations that we've seen in the past. It seems like in every technological age, there's a corresponding innovation when it comes to legal technology. So you talked about the railroads before. That was the birth of preferred stock. If anybody has raised capital or intends to raise capital for a new venture, you're basically using the same deal that emerged during the railroad boom. We saw the globalization and increasing in oil exploration lead to the generation of limited liability companies to kind of meet the demands of the age. And I do think that we're in the middle of a shift. We are no longer, and increasingly no longer, in the industrial age. I think COVID has really accelerated that process. Yet we don't have a structure that really works for the internet age. And in my mind, and I think increasingly in other folks' minds, DAOs are that structure. They are trying to help people come together to sift through the incredible noise of the internet. That's why I like this analogy of a subreddit with a bank account and rules. We can't do it by ourselves anymore. There's just too much information. We have to band together to kind of understand what's going on in our world, and we need productive channels to do that. And I think when this technology matures, as we get better tools and lower cost tools that folks can deploy, you'll start to see more and more of these structures emerge. Just to give you a sense, if you believe that analogy about DAOs being something like a subreddit with a bank account, there's over 2 million subreddits right now. So I think it shows that there's a tremendous amount of demand for people to come together around a shared topic, around a shared vision, and work together. And I think that you'll see DAOs continue to kind of fit in that pocket. And that's not even including this notion of people banding together to create something new. Let's say like an NFT. There's lots of folks that I know that are beginning to even experiment with those types of models as well. So at the end of the day, if we zoom out, I think 10, 20, 30 years, I'm sure corporations will still be there. I'm sure limited liability companies will also be there, and some of the other flavors of those entities. But I think DAOs are going to have an important footprint in that ecosystem, where you have an area where you need community governance, let's say like an open source project, where you want to kind of tap in a whole bunch of different disparate folks across the internet. I think that's where DAOs will kind of find their sweet spot. And if the technology continues to reduce the underlying costs, you may actually have just a more efficient entity off the bat. And if that happens, and that's a big question, then you may just have a superior structure off the bat. Why would you have this corporation where you have to pay lawyers tens of thousands of dollars to put together paper-based records when you could use something that's more natively digital, has proxy voting, transparency, fraud prevention and other internal accounting related controls built in, and that can talk to all these other organizations that may be using similar infrastructure. It's going to be hard for these legacy institutions to compete.
You see the obvious advantages of that on the transactional cost of just legally tracking who owns what in a company is a colossal function that all of these large enterprises are required to implement. And it is costly and tedious, and it doesn't make the company deliver services or take care of their customers more effectively. I would like to we don't have a whole lot more time, and this is sort of a big one, but these conversations, all got started early, almost a decade ago, and it was like, what is it going to look like 10 years from now? And I think if we're all being sort of honest about it, it's, probably made more progress than we could have expected over the last 10 years. What is your view on graphing DAO capabilities onto government, and talking a little bit about what a new model for democratic governance could look like in a world where we really empower citizens to have a more active voice in alignment with the policies that we are all dealing with in a pluralistic society? I'd love to just spend a little time thinking about that, because at the end of the day, we're operating in a much more complex geopolitical environment than ever before. And I'd just love to hear your thinking a little bit on how this technology could be implemented to make government more transparent, efficient, and aligned with the interests of the people that live in those governments.
Yeah, I mean, I think one of the things I love about DAOs is that they really do have these deep-rooted notions of democratic processes and procedures embedded in them. It kind of aligns with another trend in corporate governance related to stakeholder governance. So how do you get all the folks that are impacted by a particular company or project or initiative involved so that they all have a voice and a seat at the table? And I do think a lot of the technology that we're going to sort out with DeFi projects, with some of these early emerging projects, will set up a playbook that hopefully over time can bleed all the way up to the government. Now, the government would need to accept some of these changes, and they still struggle with some basic technology. So I don't know how many more years it's going to take for them to adopt this. But if you have the ability to delegate votes really easily, there's this notion of liquid democracies, or kind of like a more expansive version of proxy voting, where you can provide your vote to somebody else that you think is in a better position to do it. And you can imagine, kind of more organic election processes where it's not this rigid political party, where you have to go through a handful of party experts who decide and appoint the king or queen or regent, whatever you want to call it, to be elected, but it happens on kind of a more bottom-up approach towards things. I think even more broadly, you can imagine some of these accounting controls being used, at least on a local governance type way, to make sure that there isn't local fraud or local corruption or some other issues. And I guess the last area where it probably would be helpful for governments, and again, this is way out in the future, so lots of problems if you're raising an eyebrow here, but it's faster, right? We know the internet is just really fast. You can put up things and come to decisions in a snap. I'm a part of a whole bunch of different DAOs, and you can see this hive mind working. You can see that when you have lots of different people that are all have their own networks, that are all looking at different parts of whatever they want, all this amazing information comes to light, gets surfaced pretty efficiently, and then if people are given those democratic tools, they can act rapidly and efficiently and effectively. And that, I think, is one of the challenges right now for democratic processes. They're really slow, and they're so slow that people are looking to autocratic models for some sort of salvation, and I am deeply worried about that. That is not a world that I would ever want to live in. So I imagine if we can nail the cost, if we can nail the speed, if we can nail some of these controls, we could imagine it bleeding up at some point into the governmental sphere, and I hope we get there at some point too.
I was worried we were going to run out of time and not get to cover our very long list of questions for Aaron here, but I would be remiss if we did not at least spend a little time on the news out of Wyoming and talk about what that news was, its significance, and what it may mean going forward. Aaron, what happened in Wyoming last month?
So Wyoming, as I'm sure folks that have paid attention to digital assets and Bitcoin and blockchain technology may have noticed, but Wyoming is a big supporter of the industry and ecosystem. They passed, at this point, I think well over 13 bills, kind of running the gamut from classifying tokens to how to custody assets to even creating kind of new forms of banks for folks that want to deal in digital assets. And this is kind of the next step in Wyoming's evolution towards becoming a friendly place for digital asset companies. Under the bill, you can now register, and this will be effective in July of this year, a DAO. So you can set up something called XYZ DAO. So if you wanted to start, blockchain DAO, you guys can begin to do that. In order to do that, the bill's constructed in a way that you only need to submit one document to the government, which lists the underlying smart contracts that you're going to be relying on. It can list other provisions and deal with other risks that you oftentimes find right now today in a limited liability company's operating agreement. You can push that all the way up to one filing, and you can clarify all these little questions. You know, what's going to govern? Is the code going to govern? Is the written language going to govern, et cetera? So it's, I think, a huge step forward for the ecosystem, just in terms of recognition. Presumably over time, once lawyers work together, I imagine some certain form agreements will be put together that can hopefully lower the cost of setting these things up. And then last but not least, it really, I think, tries to capture this notion of a DAO, which is not that you're entering into some sort of fiduciary relationship with all these other folks. That doesn't make sense. Like, imagine if you were a fiduciary with everybody in a subreddit, it would be insane. And for those that don't know what fiduciary means, it tends to mean like you have a heightened obligation. You have to treat people extra carefully and special. So imagine if everybody that's like shit posting on a subreddit had to treat those trolls like with special duties and obligations. So we kind of like rip that out a bit and just change the defaults. You can decide that you want to do that, but that's not going to be the default. The default is those fiduciary duties are relaxed. It's presumed that people may have conflicts of interest. If you're getting large groups of people, those are unavoidable. And we tweaked a lot of those, some other kind of nitty-gritty issues to hopefully reduce the cost. And I think that this is really the first step, and there's problems with the bill, and there'll have to be enhancements to it. It's the first step in really trying to build this out. The other exciting thing about Wyoming, and I hope they get to this point, is that they are hoping to have an API that you could push into to set up a company, which would include a DAO. So you can imagine this future where if you're a developer, you're sitting on your computer, you pop up something like terminal, you could bash in a couple commands, pass through a couple variables, pay in Bitcoin or Ether or some other digital asset for it, and you're kind of off to the races. So we're not there yet, but I think we're taking another step closer to that. In terms of next steps for the bill, again, it's getting implemented in July. There's some amendments that are being worked up. There was some language that got changed during the legislative process, which is always an interesting one. Grumpy lawyers grumbled like they like to, and hopefully we'll clean up some language and try to get it into a place that really is workable. So super exciting. I think it's widely validating. And as I noted before, there's about $1 billion in DAOs right now. I imagine that number is going to go up and to the right as people feel more comfortable kind of playing around with these structures. And hopefully, the last point here is that some well-intentioned DeFi projects that really do want to interact and build successful projects or have communities that are running successful projects, hopefully this can serve as a way for them to begin to interact with the traditional world. Setting up treasuries, paying taxes, really nitty-gritty basic stuff that's boring but important for more broad, widespread adoption.
Future is going to be interesting and weird.
Yeah, bring it on, right?
Exactly.
I mean, the internet is weird. I think we just need to accept it. Tyler Cohen has been saying that quite a bit. I don't know if you all listen to him, but he's like, look, the internet is weird. We're entering into a weird era. Let's embrace it and just try to harness it for all of its good. So I'm ready for this world where we're trading memes and setting up DAOs and digital assets are everywhere.
Well, thank you so much, Aaron, for joining us today. We really appreciate your insights. And that was, I think, one of the more interesting conversations we've had on our podcast, especially around where the world's kind of going. So thank you very much. We'd love to have you back again at some point.
Yeah, at any time. Thanks so much, Nicholas and Garrick. It was great chatting. And obviously, blockchain, as my first Bitcoin wallet, I will always have a special place in my heart.
Thank you very much.